To our first webinar. It's going to be the first in a series that we're going to do over the course of the year. I thought this one was a good one to start off with because I think in a lot of instances we're so busy working in the business, worrying about sales, managing staff, trying to get new work, marketing, all those sorts of things. And for some reason, the profit and loss and balance sheets and any other reports get sort of put in the background, probably because we're relying on our accountant and bookkeeper to keep us up to date with what's going on. But I do think you need to take time out to really know about these numbers and to take an interest in them, because really they're one of the main areas where you're going to improve your business. Just slight changes, as I'll show you when we go through the presentation, make a very big difference to your end result. So the thought for the session: the budget is not just a collection of numbers, but an expression of our values and our aspirations. So not everyone prepares a budget, but I'm hoping after this you'll go away and put that budget together. And it's really got to be, as it says, an aspiration as to where you would like to be, in 6 months' time, 12 months' time, whatever. And the only way to get there is to have a goal for yourself. Okay, so the agenda for today: why you need to know your numbers, overview of the reports, the difference between profit and cash. We'll go through the key drivers of business value, protecting your assets, adopting best practice, and next steps and questions. In regard to the questions, we will take questions throughout the presentation, but we may wait till we get to the end of, for instance, we're going to do the profit and loss and trading account. We may wait to the end of the profit. I've gone through the profit and loss, so you can ask questions about those. So feel free to ask questions throughout it, because you don't want to forget them and leave them to the end and not quite remember why you had that as a question. So we're happy to take questions throughout. Okay, let's get started. So why you need to, by the way, I've had COVID and I'm still recovering. So if I've got to clear my throat, unfortunately, I'm going to have to occasionally do that and take in some water. And I don't wish anyone to get COVID. Not very nice, I can tell you. Okay, so why you need to know your numbers? Firstly, they tell the story of your business. They're going to tell you how you're performing in terms of making money, losing money, cash. Everything that you really need to know about your business can be found in your financial reports. You can also identify the symptoms and root causes. So, for instance, your gross profit margin may have been decreasing. Why is that? Is our purchasing very poor? Have we not kept up with the margins, the profit margins? Are we taking too long to do the work if we're in a business, in a service business, like accounting business or lawyers? Because it all comes down to how much time you put into it. And similarly, that would apply to doctors, anyone in the clinical side of things. If you're going over time constantly on your appointments, then that'll affect your thing. Early warning signs, an example of that: accounts receivable. If you're not monitoring your accounts receivable, they may be blowing out, which is going to affect your cash. And then it's very hard to drag it back in. What I find with accounts receivable or debtors is that if you aren't, or if you don't have a system for following up, then your clients will take advantage of you, and they won't pay until you chase them up. We'll look at areas of strength and weakness. It supports better decision making, 100%. How can you make a decision if you don't know how you're tracking in terms of your profit? And knowledge is power. Isn't it better, I think, that you understand your numbers, so therefore you're not relying on your accountant or your bookkeeper? I mean, obviously you're going to bounce things off them and make sure what you're thinking is correct, but having that power and understanding really tips the scales in your favour as well. Okay, so overview of the key reports. We're going to look at the trading account. We're going to look at the profit and loss, the balance sheet, statement of changes in equity. We're going to look at the depreciation schedule, and we'll touch on the shareholder current account as well. Okay, firstly, the trading account. Now, not everyone has a trading account. It usually applies to manufacturing businesses, people that are selling a product. However, I've also come up with a trading account for service-based industries, which I'll show you as well, because I think you need to know what it's costing you to make that income. And you can do that even in the service-based industry. So in terms of the trading account, it tracks sales, variable costs and gross profit, indicates whether your margins are improving. It uses multiple trading accounts. Small adjustments have a huge impact on overall results. And we'll go through and have a look at that. So this is Foods Company. They are they sell products. Could be pet food, could be anything really. So their sales are $1,017,000. Their cost of sales are $318,000. So there's, in this instance here, there's really two gross profits, or they call it here gross surplus from trading. But you want to know what's your markup, or what's your gross profit margin rather, on just purely on the product to start with. So it's costing them, they're selling them for $1,017,000. To actually buy that product is costing them $318,762. So they got gross surplus from trading $699. However, there is other costs involved in getting that income. So we're looking at delivery costs, the direct wages to produce that food, to put those purchases together, packing materials, sales commissions, Shopify fees. So they're called the direct costs. And after taking those direct costs into account, we've got a gross surplus of $248,749 and a gross profit margin of 24%. So to get that gross profit margin, it's purely the gross surplus divided into the sales and come up with 24% margin. Is that the good margin? Yeah, probably in a manufacturing business like that. So that's the surplus that you've got to pay for all the other overheads that you've got. Things like rent, telephone, insurance. So those sort. Is it enough? Well, we're going to find out shortly. But working on that gross profit margin is one way of increasing, obviously, your profits. So if we can increase our sales by 10%, and we can reduce our cost of sales by 5%, and that would be buying better. Once again, it's something that gets a little bit neglected in businesses. We get so busy, we're doing it from the same supplier. They might provide us good service and things like that, but you should always be checking to see, if their prices that they're charging you are in line with the competition. And I'm going to talk about pricing in a minute as well. And similarly with the direct costs, is there a way we can save 5% on the delivery costs, packing materials? All those things need to be looked at. And when I'll talk about organisation structure a little bit later, but the problem is in most businesses, the owners are generally doing four or five different departments. So it's very easy to put something aside and just think, well, that's taken care of itself, and concentrate in another area. But really, these things need to be looked at, on a regular basis, and you will look at them on a regular basis if you're looking at your financial reports. Okay, so with the increase in sales, we've got 1,119,000 is our new sales figure. We've been able to save 5% on the cost of sales. So our gross surplus from trading is 816,893. Similarly on direct costs, we're now only 427,892. So we've got a gross surplus of 389,000. So just those small savings, and if you haven't done it in a long time, then those savings, I can guarantee you, will be there. So we've now made a difference of 140,000. Oops, sorry, 140,251, and our gross profit margins increased to 35%. So just those small things make big differences, and I do think you can do it. One of the things I'm always intrigued by is how people price, or how often they look at their pricing. And I suppose one of the things that, or most of the time, they would say, "Oh, based on my competition." In the building industry, it's usually what their previous boss did, or someone they've worked with. This is how we charge per square metre. There's not a lot of thought goes into to how we price. And one of the things, another thing that I always find is when I ask people, well, when did you last change your pricing? When did you increase it? I haven't increased it for a long time. There's too much competition, etc., etc. And that happens when you're selling based on just purely on your competition, on what you think you can charge. I mean, you've got to build a business that you sell on your reputation, and that's how you can improve your business. Start thinking about, well, we need to be known as the go-to business in this area. You know, we're experienced, we've got the knowledge, you know, we've got the service, we've got the technology. Start thinking about those things, and you can start charging a premium. It's not that hard to be increasing your prices 3 to 5% a year. And in this current market, you're going to have to. And unfortunately, you know, even to increase them by 10% at the moment is probably only going to get you back to where you were 12 months ago, because material costs are going through the roof. Wages, they keep saying wages haven't increased much. Well, I don't know where they haven't, because you try and find someone and try and pay them what you were paying them 18 months ago, and yeah, good luck. I don't think you'll find anyone. So the costs have gone up. So you really need to start looking at your pricing, and you need to be looking at that on a regular basis. And yes, you will lose a few people, and you may lose a few clients, but stick with it. Sell on the value of you and your business. And if you can't sell based on that, well, then you need to look at your business. You know, how can we improve our business? How can we get to the stage where we're charging a premium? So this is what I was talking about in relation to a service business. So quite often in a profit loss for a service business won't have a trading account. You'll generally just have operating fees, then you'll have all your expenses below it. What I'm trying to do and encourage people to do is to, well, wouldn't it be a good idea if we did create a trading account so we had some direct costs? So in this business, which is, let's say it's a psychology business, we've got clinical fees, we've got NDIS income and work cover income. And then, okay, well, what's it cost us to produce that? We employ consultants, we've got wages and salaries of the professionals, and we've got superannuation. So to produce $902,730 worth of operating revenue, direct costs at $567,328. We've got a gross profit margin of $335,402, and we've got a gross profit of 37%. Okay, so that can be a measuring stick moving forward. And if that gross profit margin starts dropping, then that's when you can say to yourself, well, what's the reason? You know, are our costs blowing out compared to our operating revenue? Are we taking too long to produce the income, as I was saying to you previously? Are we not getting enough appointments? You start looking at it. The other thing is too, I didn't touch on this in the previous one, and I'll just go back to that for a second. I do like to break up sales, but sometimes it's difficult in certain businesses to break the sales up. And I know a lot of you do have other software that you use. So you can use that software, and I encourage you to use that software to start looking at the different types of income that you may have, or the different departments that it's coming from. So I know with legal solicitors and things like that, rather than look at income, they actually have departments. So they might have a family law department, commercial law section, and they start looking at their income and their expenses based on that. So always look at that. And I mean, if you can run that report from your own software, then it can always be introduced and split up into Xero or MYOB, whatever the system is that you're using. But sometimes it's a little bit too difficult just to integrate it. I know, for instance, Tradeify with the trades give you a breakup of the different type of income if you so enter it that way. Okay, so that's the trading account. Now the profit and loss statement. So this tracks the overall performance of the business. It matches income against expenses for a given period. It provides a framework to benchmark results and is a fundamental driver of business value. Now, when I say a fundamental driver of business value, a lot of businesses, not all, a lot of businesses sell based on a multiplier of their net profit. So if you're trying to work out the value of your business, or you're trying to increase the value of your business, it is going to come down to what your net profit is. Now, in many instances, there are add backs to that net profit. So you may be paying extra superannuation for yourself. You may be paying extra wages that someone who bought in. So those things all go into adding back to that income figure, and does increase the value. But if you're looking to value your business, a lot of the times it will come down to net profit. Other businesses, real estates, etc., they're different. Their property management is based on a multiplier. Well, it's based on a multiplier factor of how much commission they take in on that. So not every business is the same, but certainly a lot of them are this way. So we had a gross surplus of 248,749. They're all our expenses. You'll notice in there is depreciation of 57,534. Now that's not actually a cash expense, but it's something you're allowed to bring in for tax purposes, which is the write-off of equipment. Most of you will know that in recent years, the instant asset write-off has really taken care of that depreciation. So you're allowed to write off 100%. That's still in now to the 30th of June 23, and they may keep it going. I'm just not quite sure. I think everything else there is fairly straightforward. So unfortunately, they're in a loss situation. 50,589 before owners remuneration, 113,000 after it. So we just want to have a look at, okay, let's make some adjustments here. So we're going to look to try and reduce insurance by 5% and rent by 5%. Now we've put in the figures going back to our trading account where we have increased our sales and we reduced our or improved our purchasing power. So we have actually had a gross surplus of 389,001. Not quite sure why the accountancy fees have increased, but maybe they're doing some coaching, maybe they're engaging with their accountant on a quarterly basis, and we're doing a lot more things, looking at the cash summaries, etc. So that's increased by 5,512. Insurance has decreased by 597. Rents decreased by 2,868. We were able to negotiate that with our landlord, and there may be other expenses there that you could reduce. So the operating surplus or deficit has now become a surplus of 138,205. Yeah, that's about it. And then actually it hasn't taken off the 63,269. So that's your profit and loss. So you can always measure that against the previous month, the previous quarter, and then you can have a look at it overall in your reports. Okay, so that's a profit and loss, and in a lot of instances, that's what everyone looks at. They just look at their profit and loss. They really don't pay much attention to their balance sheet. And I'm guessing that's because they probably don't understand it fully. So I'm going to go through this. But I can tell you now, the balance sheet is the most important report in the financial reports. And I say that because if the balance sheet is not correct, then your profit and loss won't be right. It'll be incorrect. So one of the things that we do and spend time on is making sure that we can verify every item in the balance sheet is correct. If we know that's correct, then the profit and loss must be correct, except by some coding issues, but the net profit will definitely be right. So the balance sheet measures the net worth of the business at a point in time, shows you if your business is solvent. Comparisons between periods is possible, useful at tracking strength of the business, and a basis for calculating some key ratios. So let's have a look at the balance sheet. So this is just a typical balance sheet. Equity shows our retained earnings to date. You've got your bank accounts, which you're all familiar with. Trades and other receivables, so that's your accounts receivable or your debtors. They've got stock, as you were aware, being a food company. Plant and equipment, goodwill, branding, and then credit cards, trades and other payables, being your accounts payable, GST payable. So typical things you would find on there. So when we're preparing accounts for clients, we are going through and verifying all of those items. So we will look at the bank account and the credit card and make sure that it agrees to what's on that balance sheet as at that date. We'll also have a look at trades and other receivables to make sure, firstly, that they are correct and that they are collectible. Now, one of the common things we find there, and this is why we do look at it with our clients, is sometimes when money's received, it doesn't get set off against the invoice. Unfortunately, it gets put into sales, and then you get that double up. So quite often when we query something, well, how come this is outstanding 90 days or 120 days? It's because it's been miscoded. So it's important to look at that. Inventories,
trying to get clients to do stock takes is difficult. Often that's a bit of an estimate unless they're running an inventory system. Property, plant and equipment, we're going to have a look at a depreciation schedule a bit later. Goodwill won't change, so they must have bought a business of some sort. Branding similar, might be a patent or something that they've got. Trades and other payables, similar thing. We'd always have a look at that with clients and make sure that it is correct, that we haven't miscoded something. GST, payable employee entitlements. Employee entitlements is not often shown in the balance sheet. People rely on their software to be able to tell them what people are entitled to. But when you start employing a lot of people, it's not a bad idea to have that on there, because you should be making sure that everyone is taking holidays. They should have no more than 4 weeks built up for a number of reasons. One is because it's going to be costly, and all of a sudden they're going to be away from the business. And not to put anyone or scare anyone, but often if employee entitlements, say someone's got 4 years worth of haven't taken holidays, from an audit's perspective, it's not good, because they could be covering up something. They don't want to go on holidays because they're covering up something. But anyhow, from a cash flow point of view, you should always make sure they take their 4 weeks holidays. And because of COVID, we have a large build-up of people not having had to take their holidays. So really have a look at it and try and get them to take it. Finance leases, etc. So current assets, current liabilities. So in this situation here, let me have a look. That doesn't look right, but showing it that we've got net. Oh, sorry, yeah, we've got the total equity. So we've got net assets of 105,518. So some of the things we would look at and try to improve if we were discussing this with a client is we look at the debtors days. So debtors days is 26 there. Yes, so debtors divided by sales times 365. So we're taking 26 days to collect. If we could improve that by 5 days, there'd be an extra $14,000 that we have in the business. So that's one thing you look at. Inventory is another one. And inventory covers a number of things. We don't often look at the stock. I mean, in this instance here, they've only got $64,000 worth of stock. Not a huge amount of stock, but imagine if you were carrying $200,000, $300,000 worth of stock. How much of that stock is dead stock? How much of it is moving? You want to be turning your stock over every 5 to 6 times a year. So that's something we'd look at compared to your sales. How many times a year are we turning that stock over? So, and again, if we were to improve the turnover of stock by 9 days, there'd be $7,860 extra in our account. Chantal, do we have any questions today?
Not yet. You can keep going for now.
Okay, good. So shareholders' current account. Now, this is something we, once again, encourage clients to look at, because if you're not the one doing the coding, then whoever's coding it, be the bookkeeper or an accountant, may be putting things into your shareholder account that is being miscoded. They've misunderstood it. It could be deductible. It shouldn't be going against you, etc. So the shareholder's it's a running record of funds introduced and taken from the business by shareholders. It's a way of monitoring personal expenditure made from the business, ensures a record of different balances, shows what's owed to each shareholder by the business. So this is why it's important. Even if you're in a business, if you're in a company, you'll get paid a wage, but you've got to try and understand that that wage is supposed to cover all your expenses. So if you start taking money out over and above that, it's going to go against your shareholder current account. If you're in a partnership or you're a sole trader, you don't pay yourself wages. It's very easy. I find a lot of them don't draw a regular wage or take a regular drawing. It's I'll pay for this, I'll pay for that, I'll pay for that, and they lose track of where they're up to. So when I say shareholders' current account, that could also be a drawings account. And this is just typical. Mr. Doe, opening balance, funds introduced. Now, some of the things coming out, general drawings. They could be up for other things. Life insurance, which isn't tax deductible. General drawings could be, I'm not sure,
just something over and above. But anyhow, they've decided to take it out. They haven't paid it from their wages. They've taken it out of the business, so it gets added in there. So at the end of every year, I strongly encourage you to have a look at your shareholders' current account, because if that falls into you owe the company money, then that creates an issue with the ATO. Okay, it can be fixed by paying dividends, but if you owe the company money, that's what they call a debit loan account, and really that's income that should get added to your wages. So it's always important to go through that and make sure that everything that's in there is correct, and that you understand why it went there and you agree with it. And then we try and rectify that situation from what I call a debit loan account. Fixed asset register. So this records the fixed assets. Vehicles, plant and equipment facilitates the spread of cost of assets over their useful lives. So basis for keeping track of business assets, a useful guide to an annual asset replacement budget, and helpful when selling the business. Now, this has really got out of hand. So go back 3 or 4 years ago now, before we had instant asset write-off, everyone had to depreciate their any assets that they bought. So if they bought a car, they bought machinery, they might have bought furniture for the business, carpets, etc., etc. So they'd all get recorded on the fixed asset register. And you can see there, motor vehicles, office equipment, plant and equipment, etc., etc. Now, what's happened? So if someone wanted to know, what their assets were, or if they were selling their business, they could tell the purchaser, well, these are the assets that we've got. What's happened with instant asset write-off that we've found is that a lot of it is going directly onto the profit and loss and being correctly called instant asset write-off. However, the only problem with that is there's no record of that asset being purchased. Now, we've got a couple of instances now where we're having to go back. They've used previous other accountants. We're having to go back and try and fix that up. And I'll tell you how you can work that. So you've got the cost, the original cost, you've got the opening value, so that's after depreciation over a number of years. Okay, they purchased a website that year. You can see the rate there. That's the ATO rate for what you're allowed to write those vehicles off using what they call the diminishing value method. So it's writing it off and reducing over years. What should be happening, if you purchase an asset, let's say you purchased a vehicle for $40,000, it should still get recorded on the fixed asset register. So we've got a track of that vehicle and we know that it was purchased. And in the depreciation, in that rate section, it should be written off at 100%. So yes, we've got a track of that, we purchased that, we get the instant asset write-offs, we write it off at 100%, and then we have a closing depreciation rate. And you'll see software, computer, and iPad. The closing rate in that instance would be 0. And we get to claim that in the profit and loss. So we're still getting the same benefit, but now we've got an actual record of the fact that we purchased that vehicle. If that wasn't on there, in 3 or 4 years' time, you wouldn't know you had that vehicle. You would, but no one else would. And when a vehicle may stand out, but when you start talking generators and freezers and other machinery, etc., it can quite easily get lost and you forget what you've had. So very important, put that instant asset, put that asset that you purchased on the depreciation schedule, claim the rate 100%, and yes, you'll still get the tax deduction. And there's your closing depreciation rate. So that's saying the value of those assets is 267,808 based on the ATO depreciation rate. It may or may not be correct, but it's probably reasonable. Reasonable to say that that's what the machinery is worth. If you were selling that business, that's what you've listed at. Okay, excuse me. Just get a bit of water. Okay, the difference between profit and cash. And this is something that a lot of people do forget. So turnover is vanity, profit is sanity, and cash flow is reality. So what are some cash items? So GST, we collect the GST. Loan repayments. That's cash going out of the business. Now that's not going to appear on the profit and loss. That's going to appear on your balance sheet. It's going to reduce the loan down there. Interest on loans, that is going to appear on the profit loss. So we've taken into account the loan repayments, but we can claim back that interest. Asset purchases, same thing again. Currently, yes, because of instant asset write-off, it's appearing on there. But when we go back, if instant asset write-off stops, that won't appear on the profit loss. Asset sales, similar. And depreciation is another item. Now, that doesn't affect cash, but it does affect the profit loss. It reduces the income in the profit loss, and we're allowed to claim it based on a reduction in so depreciation was there always before the instant asset write-off came into account. Now, that's important, and you can actually run a report, which a lot of people don't run. So most people run their profit and loss in their balance sheet, but there's also a cash summary report. Excuse me. In Xero, you can run a cash summary report, and that report shows you all income in. So that'll include your sales, it'll include your GST income, and every expense out. So not only the expenses that are in the profit loss, but it'll also show you the loan repayments out, if you purchased any assets, any drawings, etc., etc. And that bottom line will tell you the cash movement for that month. I think that's important because you may look at a profit situation, and that's great, but it's always based on an accrual system. But in terms of cash, you may be going backwards because your accounts receivable, your debtors are blowing out. We haven't received that money. Okay, so that cash summary is a good report to run to show you that. This is just a follow-up of what I was talking about there, the business 101 cycle. So you've got the investment, the owners invest in the business. They use that to purchase assets to generate income. They may also get a loan to buy other assets or for working capital. You then got the profit, so that's a return on those assets. So some of the things that help with adding to the cash is the profit gains, sales growth, and improvement in that gross profit margin. Things that will drain the profit, unchecked overhead expenses. So if you're not looking at those expenses, then yes, you could be blowing out and the profit could be reduced. That's going to drain your cash. Generated from business activity. So the drains on cash, slow collection of debtors, which I've spoken about. So if they're not paying properly or within terms, then that's going to reduce your cash. Your stock can increase or your work in progress, same sort of things. You know, we're not getting that work out quick enough. So our work in progress is increasing, but we're not getting the job finished. And similarly with stock, you know, and there may be reasons why your stock increased. It may be a seasonal, you know, or you're taking advantage of some discounts. As long as you know why it is, that's fine. But if you're not keeping a track of it, then that's when it becomes business loan repayments, business tax payments, and paying your suppliers faster, which, you know, may lead to discounts. Some of the things that help with the cash, faster collection, decreases in stock or work in progress, slower payment of suppliers. Unless they're going to give you a discount, well, then you certainly wouldn't pay them any quicker, I wouldn't think. You just stick to your terms. I don't encourage you to go outside the terms. I think you stick with the terms. But always have that conversation. Just say, well, listen, if I pay you, you know, in 15 days or 14 days instead of 30, you know, is there a discount? Quite often there could be. Then reduce tax payable. Invest in the business, drawings, cash taken for own use, personal loan repayments. Those things are going to drain it from there. So accelerate the spin cycle to increase your return on investment. So we've gone through all the reports, and I've spoken to you, bearing in mind you've got the profit loss, you've got the balance sheet. You've had a look at the depreciation schedule. I've told you about that cash summary report. I encourage you to look at that. Now, the other thing, when you're looking at your business and you're starting to look at those numbers and things like that, you need to look at, well, what are the key drivers, and list the key drivers of the business value. So, you know, they're often referred to as your KPIs or your key performance indicators. So if you haven't established those, then you need to start, you know, giving it some thought, because the only way to make yourself accountable is to have something to measure yourself against. If you're an athlete, then you're going to be measured against time. in terms of your performance, or if it's a strength thing, how much can I lift, all that sort of stuff. So they're always held accountable, and they've got something to measure. We need the same in business. It really is a driver of increased profit, and not only that, but increased value of the business. So it's different for every business. So a food company opposed to a service company, they're going to have different drivers. So knowing yours is essential. So examples that I would show: monthly recurring revenue, revenue growth, revenue per client. Another one I would add to that, and I'll talk a little bit about the non-financial ones in a minute, is the average dollar sale. So measuring the average dollar sale in different to revenue per client, because you may not have a recurring client. You may just have clients that come in, or you're selling online, etc. But one of the things to work on is improving that average dollar sale. McDonald's are a classic. They're always trying to upsell you. So just add on $1, for something, McFlurry, or upsize it. So that's what I'm talking about. They recognise that the value, in terms of increasing their profit and the value of their business, a lot of it comes down to that upsell. And many businesses are the same. The banks, do it with insurance, etc. So have a look at that average dollar sale, which is really the number of invoices divided into your sales. And if you're running a system separate to, say, Xero, for instance, or anything like that, you can probably print out a report for that. Sales and profit, accounts receivable, I'd be measuring definitely to see how quickly we can collect. A lot of businesses these days have been able to get it so once the job's finished, then you get paid. So don't say that, okay, well, in our industry it's not done that way or whatever. Someone's got to go forward and change that, because really you'll finish that job. Why shouldn't you be paid? And why shouldn't you be paid straight away? And not take that a step further. Why should you wait for them to pay you? Why not have something along the lines of a direct debit and you get paid? In my opinion, it's only fair. They're happy with it. You issue the invoice, you collect your money, rather than waiting on their bookkeeper or whoever to approve it. This is just something to think about. So I've mentioned a couple of, or a few there that are what I'd call the financial KPIs. Then you've got your non-financial KPIs. So if you're doing marketing, then there's a few things you should be looking at. So you should be looking at the increase in the number of leads in a month, where those leads are coming from. I'll be tracking. Are they referral? Are they from our website? Are they from our Google AdWords? I want to be measuring those. I'd also want to be measuring our conversion rate. I can tell you now, if you don't measure your conversion rate, in your mind, you'll be thinking you're up around 80 or 90%. Realistically, the conversion rate sits between 30 and 50%. I know people are surprised at that, but that history shows, or people that have measured it show that that's the case. I mean, in some industries, I'm just trying to think of one, building renovations, it's as low as 12 to 15%. Why? Because a lot of people are just out, well, how much it's going to cost. They get a quote, then they realise how much it's going to cost. They haven't got their finance organised, etc., etc. So they get a lot of inquiry, but the conversion rate is very low, and you really should be measuring those sorts of things. Okay, enhancing business value. You're in business. At the end of the day, you would like to be able to sell that business. So it's important to always have that at the back of mind. So enhancing your business value. So we've spoken about what you can do. So you've got to implement a clear plan. I spoke about documenting your organisation structure and roles. Those things are important when you're selling a business. A business that is a turnkey business. In other words, I can walk into that business. Employees are all know their jobs. They're all got a position. They're all doing their work, and I just roll in, and the business continues to roll on. We've got systems and processes in place. It's all documented. That business is very valuable. Okay. as opposed to a business where maybe everyone knows what they're doing, but it's not written down. Someone leaves, well, you get a replacement in, well, the time taken to show them how to do that job, all those things add up. It devalues that business. Establish cloud-based real-time reporting. I think most people these days are using some sort of system. We're definitely a zero-based firm, so we push for zero. But there's MYOB and QuickBooks as well. But you need that real-time reporting, and there's no reason these days not to have it. Review and document systems and processes. That's what I spoke about in terms of adding value to your business. The sooner you do it, the better. It is very time-consuming, granted. Don't expect you're going to get it done in a month, depending on the size of your business. It's a 6 to 12-month project, but it needs to be done, and someone needs to start it. And the whole idea of that is then we're reducing the reliance on the owners. And if a business runs without its owners, or can run without its owners, then it's a very valuable business. And identify and manage any risks. Okay, so adopting best practice. 3 essential business tools. You should have an annual plan. Now, we call it a strategic plan. So every year you look at it, you do a SWOT analysis of your business, you look at what you achieved and what you didn't achieve. You go through a number of other things. The whole idea is you come up with some goals for the year. Now, you don't want to go too crazy on that. Really, I'm talking major goals, and there probably should only be 3 to 5 at the most. Some will be a 90-day goal, others will be 6 to 12 months, like the systems and processes. That may be one of your goals, but you're not going to get that done in 90 days in most instances. You always should have a forecast or a budget, and you should get ongoing reporting and accountability. So your reporting is obviously your profit and loss at the end of every month, and then maybe meet with your accountant every quarter. But we also need to measure your KPIs, because yes, we've got the reports, but what were we aiming for? Did we meet what we were aiming for? Did we meet our budget? And if not, what were the reasons for not doing it? And there could be legitimate reasons, but we've got to then keep working on it. The more you look at your numbers and you understand your numbers, then you're going to get your results are going to improve. So knowing your numbers is just the beginning, and that's basically it. I think we're going on time. So any questions come up, Chantel?
Yeah,
Does
so
anyone, if they've got
I do have a
questions?
question here for you. As a sole trader, much of this is a weak point in my business. I don't really have a proper budget or balance sheet. What resources would you recommend for an absolute beginner to help build confidence and understanding with knowing your numbers? Budgets for dummies kind of thing.
No, just for dummies. Okay, yep. Look, first thing I'd do is I would 100% have some software that is cloud-based. So you don't want to be spending too much time on that. And if it's cloud-based and you're getting your bank statements, for instance, or bank feeds coming through, then it's a very simple process. You can do it yourself, or even you can get a bookkeeper to do it. But if you're really interested, it's very easy to pick up. And it's not very time-consuming, but you do need it. See, that's your starting base. You need to know, well, what are we looking at? We've got income, we've got expenses. Then you need to take time and have a look at where you want to be. So here I am now. My turnover is 100,000. What would be a great result? Okay, a great result might be 300,000. A good result, 200,000. Just an average result, I'm staying where I am. So we've got to look at, well, how do I get to those other figures? How do I get to 200 or 300? What changes do I need to make in my business to allow me to get to those figures? Now, it could well be that, and being a sole trader, and not only sole trader, it applies in a lot of businesses, time is a big factor. So how are you managing your time? And we have tools, and Chantel, you might want to send this out, about managing your time. We call it reclaiming your time. That's a starting point. What are you doing? Where are you spending your time? What's important? What's going to move this business forward? Okay. I know you asked about the budget. But the budget isn't that difficult. If you speak to your accountant or whatever, putting that budget together, is a fairly straightforward process depending on what industry you're in. But yeah, I hope that answers the question. But there's a few things you need to be doing as a sole trader to take yourself from 100,000 to 300,000. Yep. Anything else?
Okay, great. I'll send that out with the guide to the financial reports as well this afternoon.
Yeah. Yep.
Just
anyone else that wants that, by the way, just ask Chantel and she'll send that through to you.
Yeah, I'll send that through for sure. What is the difference between the annual accounts and accounts that can be produced throughout the year?
Oh, okay, yes. So the annual accounts will be the ones that your accountant produces, and they will take up end of year adjustments. For instance, depreciation is the classic. So when you're doing having your reports throughout the year, a lot of the times they won't include depreciation because they're done at the end of the year. You might be buying assets off and on during the year. So those interim results, or the monthly or quarterly, unless you actually take up an entry and put a recurring entry in there for depreciation, they won't take into account those sorts of things. And there may be other write-offs that aren't taken into account in other areas as well. So at the end of the year, you really, remember when I said about that balance sheet, you're really going through that balance sheet closely and making sure that everything is correct. There may be bad debts we can write off, but you wouldn't do that generally until till May or June, when you're looking at it, doing a bit of your tax planning, and then you're getting ready for end of year. Yep.
Okay, that's it. Good to go.
Okay, so I hope that was useful to you. You've really got to go away and put it into practice. By all means, even after today, feel free to send us questions through. We're happy to answer those. I think understanding your reports is important, but I do think establishing those key performance indicators is it's a way of holding you accountable to your business. And when you're in business, you're really accountable to no one. If it's your business, other than the bank and maybe your spouse, to make sure you can pay for everything. But other than that, you can sort of do your own thing. So having those key performance indicators, I believe, is a great, an essential tool for your business. Appreciate everyone coming to it. It was our first one, but as I said, we're going to run another one every 3 weeks, roughly. Well, I think it is going to be, not roughly, I think it is going to be every 3 weeks. Our next one, I believe, Chantel, is 7 ways to massive profits. So we're going to look a bit more about the non-financial, how you can grow your business. Okay, thank you very much. Appreciate it. Oh, lastly, how we can help you. So in terms of what we offer, I spoke to you about the strategic planning session, where we do a bit of a SWOT analysis, look at what you've done in the past and what are the roadblocks, what's stopping you from getting to where you want to be. So that's a 2, 3, well, probably a 3-hour session. There's workbook handed out, and then we meet and we go through it. So that's a one-off thing. You can take that strategic plan and you can go away and you can work on it yourself. You've set your goals for the year and you can track yourself. So that's a one-off. It's 1,200 plus GST. We're starting a coaching program. So this is for people who really want to understand their business or maybe new to business. So we're going to have 8 sessions. There's going to be 7 sessions based on different things. So, know your numbers will be part of that. There'll be marketing, sales, all different topics, organisation structure, creating a vision for your business. They're run fortnightly, and the cost is $250 plus GST a fortnight. I also do one-to-one coaching. It's $660 a month. There's no contract. You can leave whenever you want to. If I'm not adding value, then I wouldn't expect you to stay. So it's a 1-by-1 hour session a month, and then I generally do a telephone hookup mid-month just to see that we're doing the things that we spoke about at the last meeting. So we're discussing throughout that 1 hour session, what happened in the business in the last month. We always look at the financial reports. We always have action items from the previous meeting, and then we set action items for the following one. And if you're not sure and you just want to talk, we have a complimentary meeting, which is free. It's a 30-minute meeting. It can be done face-to-face, Zoom, telephone, just to help you and make you understand. And then, there's no obligation, obviously, once we've had that meeting to do anything else. Started a Facebook group, join our Building Better Business Community Hub. Now, we've had quite a few people join, but what I'm trying to do is I'm trying to get it to be a conversation. So if someone's got a question, and it's got to be business related, not tax related. We don't want tax questions in there because we don't want everyone sharing their opinion when they're not qualified. But certainly in business, the question may be, well, how can I improve my debtors? How can I reduce my debtors? Now, other people in that business hub, including ourselves, so we'll always answer that question as well. But there'll be other people that can share their knowledge. There's some very, very knowledgeable people in that have joined that business hub. So that's what we're really trying to do. So it's not just going to be us posting things. We're going to put resources in there that you can use. So that's another thing to always have a look inside that hub. So as it says, the idea of the Building Business Hub is to build a community of like-minded business owners who are working hard to build their businesses and achieve spectacular success. Feel free to ask any business questions. It's hoped by other business owners sharing their experiences, we can provide solutions to your questions. We'll also share great business insights. Coming together is the beginning, working together will lead to success for us all. So it is a community. Don't be frightened to ask a question, because there's probably other people that want to ask that question and might be, for whatever reason, frightened to ask. There are no silly questions. Ask that question. If anyone else wants to comment on it, excuse me, by all means, make a comment. But everyone's there to help each other, not to pull each other down. So, hopefully we can build that community. I think it'll be good. Thank you, Chantal.
Great, all done. I think that was it. Thank you everyone for attending. I'll send out the guide to your financial reports and the time management skills information as well. And if you do have any questions, feel free to contact me and Rick and we'll get back to you straight away.